What's going on, everybody? Chris here from Project Option, and in this video we're going to talk about trading VIX options. So if you're familiar with the VIX Index, you may know that you can't trade the VIX Index directly. However, there are options on the VIX Index, and in this video we're going to talk about things you need to know before trading VIX options. So what are VIX options? Well, the VIX Index is an index that tracks the 30-day implied volatility of SPX options. However, the VIX is just an index and can't be traded directly. However, there are options on the VIX that can be traded. And in fact, VIX options are some of the most liquid options in the market that are available to us options traders. In 2016, VIX options had an average daily volume of 587,000 contracts, which translated to over 148 million contracts for the entire year. So you might be wondering why we have an entire video dedicated to VIX options themselves when everything on our website and all our videos talk about trading options. Well, the reason is that VIX options have a few nuances to them that you need to be aware of. VIX options do not operate the same way that standard equity options do, and therefore people who are just getting into VIX option trading might have results that are unexpected. So that's the goal of this video. So the first nuance that you need to be aware of is that VIX options are not priced to the VIX index. They're priced to the VIX futures with the same settlement date. Number two is that VIX options settle to a special opening quotation, which is the ticker symbol VRO. And VRO is a VIX style calculation that is calculated on the morning of VIX option settlement. And lastly, long-term VIX options are less sensitive to changes in the VIX index than short-term VIX options. So since the VIX index has no tradable shares, VIX options are not priced in line with the level of the VIX index, because normally the stock and the options can be used interchangeably to create equivalent positions. But since there are no tradable shares for the VIX, that relationship doesn't exist. So to demonstrate this to you, let's compare the prices and intrinsic value of deep in the money options on various equities and then the VIX. So let's start with Apple. Let's say Apple's trading at $109.40, and we look at the January 200 put, so the extremely deep in the money put. The options price in this case was $90.60, and the intrinsic value of that put is $90.60, so no problems there. Now Tesla is trading for $181.85, so looking at the January 400 put, the options price is $218.55, while its intrinsic value is $218.15. So again, no problems there. The options price is trading for more than its intrinsic value. So lastly, looking at the VIX at 1415, the January 50 put has a value of $33.50, while the intrinsic value of that put to the VIX index is $35.85. So clearly there's a problem because the options price is not at least its intrinsic value. So now let's go ahead and compare that same option to the January VIX future. Okay, so now we're looking at the January VIX future, which is trading for 1660. Looking at that same January 50 put, we can see that the options price is $33.50, while the intrinsic value to that January VIX future of 1660 is $33.40. So when we look at the options price to the VIX future, the corresponding VIX future, we can see that the options price is very accurate and it's almost priced exactly to the VIX future. Now to further demonstrate this concept to you, we track the price of the VIX index to the effective cost of a long synthetic stock position using VIX options. So a long synthetic stock position consists of buying a call option and selling a put option at the same strike price and in the same expiration cycle. So if the trade is entered for a debit, the effective cost of the synthetic position is the strike price plus the debit. And if the cost of the synthetic is a credit, then the effective cost of the position is the strike price minus the credit. So the green line in this graph is the strike price plus the debit or minus the credit on each trading day. So as we see here, the long synthetic stock position using VIX options did not track the VIX index closely, which would be the case if you did the same test on a standard equity. So now we're looking at the same exact graph, except now we're plotting the price of the February VIX future against the February long synthetic stock position in VIX options. So as we can see here, the price of the February VIX future is almost identical to the effective cost of the long synthetic stock position using February VIX options. So this graph right here proves that VIX options are not priced to the VIX index, but they're priced to the matching VIX future with the same settlement date. So why are VIX options priced to VIX futures and not the VIX index? Well, as we discussed before, there are no tradable VIX shares, which means there's no put-call parity between VIX options and the VIX index. Now, put-call parity states that the options of a stock can be used to create a stock position, and the combination of an option and the stock can be used to create an equivalent position in the other option. So, for example, using a call option and the underlying stock, you can create a put option, and using a put option and the stock, you can create a call option, and using the options, you can create a synthetic stock position. So, since there are no tradable shares in the VIX, that relationship doesn't exist. Now, with that said, the VIX futures are considered to be the tradable shares of the VIX. So, using VIX options, you can create a synthetic VIX future, or you can trade even partial VIX futures with smaller size. Also, using a VIX future and VIX puts, you can create synthetic VIX calls, and with VIX futures and VIX calls, you can create synthetic VIX puts. Now lastly, VIX futures and options both settle to VRO, which keeps their prices in line with one another. Now, what I mean by that is VIX futures and synthetic stock positions using VIX options have to have the same price. Otherwise, there are arbitrage opportunities. So for example, let's say the January VIX future is trading for 15, but a long synthetic stock position in January VIX options has an effective cost of $20. Now in that situation, you could buy the January VIX future for 15, and then you could sell the synthetic stock position in VIX options for 20, and you'd pocket 5 points risk-free. Now, why is that? Well, if you buy a VIX future at 15 and you sold a synthetic stock position in that same VIX cycle for 20, let's say VRO comes out at 25 on the morning of settlement. Your profit on the VIX future would be 10 points, but your loss on the short synthetic stock position in VIX options would be 5 points. So therefore, you captured 5 points. Now, if VRO came out at 10, your loss on the long VIX future would be 5 points, but your profit on the short synthetic stock position in VIX options would be 10 points. So again, you take 5 points out of the trade. So the bottom line is that since VIX futures and VIX options both settle to the same number, their prices will always be in line with each other, because if they're not, then arbitrage opportunities exist, and the natural trading to remove those arbitrage opportunities will bring their prices back in line with one another. So let's go through some VIX option settlement examples just to show you what you might see if you have an option position that you hold through VIX settlement. So you might think that the opening VIX value on the morning of settlement should be close to what your options will settle to, but in reality it's different because VRO is just a VIX style calculation. It's not the actual VIX calculation. So it will differ. Now let's go through the examples in the table below. So in the first example, the VIX opening price was $23.40, while VRO came in at $23.76. Based on a VRO of $23.76, a 15 call would settle to $8.76, which is actually $876 in premium, since every option has a contract multiplier of 100. Now a 17 put is out of the money, so that option will expire worthless at settlement. Since VRO is above the 17 put strike, that option will expire worthless. Now, let's say VIX open was $15.96 and VRO came in at $16.22. A call option with a strike price of 10 would settle to $6.22, or $622 in premium. A 30 put is $13.78 in the money based on the VRO calculation of $16.22, and therefore that 30 put will expire to $13.78, or $1,378 in premium. Now the last thing I'll say is that VIX options are cash settled, which means on the morning of settlement, each option will settle to the amount of its intrinsic value and then disappear from the trader's account. So in the case of the 15 call, let's say a trader initially bought that call for $5. Since the call settled to $8.76, the profit on each contract for that trader will be $3.76. So the $8.76 settlement value minus the purchase price of $5. So that $3.76 profit per contract actually translates to $376 of profit per contract. So if the trader bought one contract at $5 and it settled to $8.76, on the morning of settlement, the 15 call would settle to $876 and the trader would be left with a P&L of $376. So even though that call is in the money at settlement, it's not going to expire to any shares. It's just going to expire to a cash value equal to the amount of its intrinsic value. So let's move on to another topic related to VIX options. So one pitfall of trading VIX options is that you may think that you can just trade super long-term trades to allow more time for your predictions to play out. So for example, let's say the VIX is at 10 right now, and you're thinking, okay, over the next 300 days, I think the VIX is going to rise to 15 or maybe 20 because a VIX of 10 is not sustainable. So why wouldn't I just go buy a 20 call option with an expiration date that's 300 days away? Well, the answer is that, first of all, trading longer term VIX cycles when volatility is low, you're actually trading a higher level of implied volatility because since those options are tied to a VIX future, those VIX futures are going to be priced higher than that current VIX level of 10. So that's the first reason. The second reason is that long-term VIX options are not nearly as sensitive as short-term VIX options. So while you may trade in long-term VIX option cycles, if you are correct in your assumption that volatility will increase, then you're not going to be as profitable trading in the long-term cycle as you would in the short-term cycle because long-term VIX options are not nearly as sensitive as short-term VIX options. So let's go ahead and visualize this. So the first step in understanding why VIX options with longer durations are less sensitive than short-term VIX options is understanding that short-term VIX futures are much more sensitive to changes in the VIX index than long-term VIX futures. So in this chart, we're looking at a period between September 2008 and November 2008. So we're looking at the changes in the VIX index, and we're comparing those changes to the October, November, and December VIX futures. So as we can see here, the VIX rose from 22.5 to 70 in a matter of a few months, and the October future rose from 22.5 to 65 at the highest point. Now, if we look at the November VIX future, the November VIX future started around 22.5, but it only rose to about 47.5. Now, if we look at the December VIX future, it started around the same place, around 22.5, but with that same VIX movement, the December VIX future only rose to a level slightly higher than 35. So as we can see here, shorter-term VIX futures contracts are more sensitive to changes in the VIX index, while longer-term VIX futures are less sensitive to changes in the VIX index. Now, since VIX options are tied to each VIX future, those VIX options in longer-term cycles are going to be less sensitive to changes in the VIX index. So let's go ahead and look at VIX call options in each of these VIX option cycles. Alright, so as we can see the same VIX move over that same period. So the VIX started around 20 and rose to 70. And now we're going to look at the bottom part of this chart, which shows the call option with a strike price of 20 in the October, November, and December expiration cycles. So as we can see here, each option started just below $5. While the October call rose to a value of around $35, the November call only rose to a value around $20, and the December call only rose to a value around, just short of $15. So, as we can see here, the call options with more near-term expiration dates were much more sensitive to changes in the VIX index. So, someone who bought that December call option for $5 was not nearly as profitable as someone who bought the October 20 VIX call option. So just keep in mind that when you're trading VIX options, if you have a long-term assumption about changes in volatility, just know that the changes in your position's value are going to be muted compared to the changes in more short-term positions using the same exact options. Well, congratulations, you just learned the most important concepts you need to know about trading VIX options. So let's go ahead and recap the main concepts you've learned in this video. So first, VIX options are used to trade changes in market implied volatility. In 2016, VIX option volume was just over 148 million contracts, which translates to an average daily volume of 587,000 contracts. Next, options on the VIX are priced to the corresponding VIX futures. So for example, February VIX options are priced to February VIX futures, and June VIX options are priced to June VIX futures, not the VIX Index. So options on the VIX settle to VRO, and VRO is a special opening quotation that uses opening SPX option prices in a VIX-style calculation on the morning of settlement. So know that the opening value of the VIX Index on the morning of settlement is likely going to differ from the VRO calculation on the morning of settlement. And lastly, VIX options are cash settled, which means the options settle to a cash value on the morning of expiration. So for example, if VRO is 20, a call option with a strike price of 15 will settle to $5 or $500 in actual dollar terms. Thank you so much for watching, everybody. If you enjoyed this video, please go ahead and subscribe to our YouTube channel so that you can receive all of the videos that we produce in the future.